Hey folks, George Berger here. This here is what the past few months of travel have looked like for me as I continue to visit clients and build out the Steady Trader and Blue Oak Advisors brand. I'm about to hit the road again for our next mastermind workshop in Fort Lauderdale, Florida. And if you have any interest in joining that, let us know. But what I want to go through today real quick is a couple of important charts. And these charts I think are particularly important to look at this juncture because structurally, I remain bullish stocks in 2018, at least for the first quarter. For right now, we take it one quarter at a time. But I want to give you some perspective as to the right here and right now. So here's a chart of the S&P 500. This is as represented by the SPY ETF. Very simply, what you can see for the past year, really, 2017, even off the 2016 lows, we started having a major leg higher, and last week, the first week of 2018, we finally reached the very upper end of not only the 2016-2017 trends, but also of the uptrend all the way since 2009. So we've now really gotten to the very, very upper end. If you look at something like very, very simple stuff, MACD, which is our moving average convergence divergence oscillator at the bottom of the chart, you can see here with the blue arrow that we're basically at record overbought levels. Now, again, to be very clear, none of this means that stocks have to fall apart from here and this is all over. But it does mean for me that the reward to risk on the upside here is certainly getting worse, and we're now just coming into earnings season as well. So I think there's always a better price. There's always which is more attractive for entry points for active investors and for investors long term as well, of course. So if you're an active investor looking at time frames for, let's say, a few weeks or a few months, it does matter where you buy and obviously where you take profit as well. So for me, last week, or the first week of 2018, the end of it was a good spot to start taking a little bit of profit in some things. So that's chart number one. Let me show you one more chart. And this is a very similar chart. And this one here of the Nasdaq 100 is represented by the QQQ ETF. And here too, you can see, thanks to last week's rally, again, that's the first week of 2018, nearly about 4% or so, I think, was the rally in the Nasdaq 100. The S&P rallied about 2.5%, and you can see same thing here. We're reaching the very, very upper end of the 2009 uptrends, and certainly also of the 2017 uptrend. Momentum here too is very, very strong. Now, again, it doesn't mean that things have to fall apart from here, but I think the rate of change at this rate is very, very difficult, if not impossible, to keep going. So I think for right here, right now, some profit taking is in order. We still like tech stocks. Really do the first quarter. It tends to be good for tech stocks, but I think, again, one can probably get a better price if you wait a little bit. Again, particularly with earnings season here coming around, banking stocks are reporting earnings this week here, the second week of 2018, and with large cap technology stocks reporting out in the next couple of weeks, I think it probably pays to not get too giddy right here, jumping after these names, at least not from an immediate term perspective. If you have long-term positions, I think those will be fine, and those certainly should be able to withstand even a 10-15% pullback or more if you're long-term invested in some of those large cap tech stocks. So that's it for me here. I'm going to hit the road here pretty soon, and I'll see you in the next video.